This screencast is looking at September 2016 question 2 focused on group accounts, and we're paying particular attention here to the Columnar method of preparing a consolidated statement of financial position. So again, the first thing in terms of if you get a question like this is to look at the requirements of what exactly has been asked, and then also look through the question and the notes given. So again, I've assumed you've looked through this, so we'll briefly go through them, but if not, pause this screencast to go back and look through all the requirements. In this case we have 3. What is the non-controlling interest at the year end 31st December 2015? For 4 marks, 6 marks for prepare the Goodwill working, and finally then set out the consolidated statement of financial position for 20 marks. So a total of 30 marks. With a 90-minute exam, you're talking in and around between 25 and 27 minutes you have to prepare this question. While some students would start with these, it probably makes more sense to do the whole statement of financial position as you go, and as you go through the question you will get the answers to part A and part B. Just note that if you go to and see how the booklet was laid out in September 2016, you are given details of where you'll do your working for non-controlling interest for part A, and for part B you're also given your in the booklet a table to fill in your workings for Goodwill. So again, it's important to fill them in appropriately as you go through the question, but in terms of here it probably makes sense to work through the full question, and these will come out as you go through each of your workings. Just briefly going down through the question, so Coruna is the parent, and they would have acquired Downa halfway through the current year, so 1st of April. So you can see you're given the statement of financial position for both the parent and the subsidiary. They obviously paid 1.8 million for their stake, and we're told here that they bought an 80% stake. So again, I'll be just jotting down myself. That means there's going to be NCI, non-controlling interest, worth 20%. The next thing we're told is the equity section of the sub at the date of acquisition. So of course we're going to need that for the Goodwill calculation. We're told Coruna sold goods to Downa at the date of acquisition, or from the date of acquisition, about 600k, and they sell at a profit margin of 40%, and there is stock on hand at year end. So this is important. We know there's unrealized profit, an adjustment to be made, and it's important that the parent, Coruna, is selling to the sub. So that will be important in terms of the adjustments you make. Here we have an intercompany balance outstanding at the end of the year. Therefore, we're going to have to make an adjustment there. And note 5 tells us that the non-controlling interest will be measured at their proportionate share of fair value of net assets. So in this case here, we're measuring under method 1, or it's also called the partial method. And the fair value net assets at acquisition equals their book values. And then note 6 just tells you to ignore tax and amortization. So it's useful to read down through the notes, particularly in these Consol questions if it comes up, because it tells you now we understand we have a 20% NCI, we have unrealized profit, but it's from the parent to the subsidiary. So that will not impact the NCI because the unrealized profit is in the parent's accounts. We also have an intergroup balance, and we know the NCI is measured at their share of the net assets. So again, that just gives us a good overview as we approach the question. Now, if you're approaching it in the Columnar method, you're typically going to set up the statement of financial position such as this, where, as it says in the 10, you put the 2 columns for the parent and the subsidiary. You leave 2 adjustment columns to fill in your adjustments as you go along, and you will then have a group column at the end where you will add across parent, subsidiary, and adjustments. That's typically the structure when you're preparing a consolidated statement of financial position using the Columnar method. Now note, when you are putting them in, make sure not to forget to put in a Goodwill line to leave a space, and also put in a space for non-controlling interest. Because remember, they will not be in the original individual accounts because they are consolidation account specific. Once you're finished with that and kind of have the structure set up, there's typically 2 types of workings you will do. For Goodwill, for retained earnings, and for non-controlling interest, they will be big workings in themselves. So you typically won't be adding across for retained earnings or NCI. You'll typically put a big working one here, cross-reference the note, and then come back over here where I've just set up an outline of where the big workings will be done. And by big workings I mean these are where the main marks will be going for in any consolidated question, so it's important that you understand how to approach them. The other type of working that you may have, and again I may put these in a separate page in my workings for the examiner, is the smaller adjustments. So you could call them workings or adjustments, and we really only have 2 here. we have an unrealized profit adjustment, and we have an intercompany balance. So it's important to remember sometimes you'll have these small adjustments that will impact these bigger workings, particularly retained earnings. So it's important before you do the NCI or try and finish the NCI or group retained earnings, you finish off those small adjustments because they may impact on the larger workings. So we're going to start off by doing the goodwill calculation because there's no impact on goodwill here. We have no fair value adjustment. So typically how we start off with the goodwill is we look at, well, what was the cost or the value for each of the items. So we can look on a total basis, or we can look at the parent's perspective, or we look at the NCI. So it's useful to split them out, particularly for tutorial purposes, to see where the differences come from. So in terms of the parent, so we'll just put in here thousands. The parent here is 1.8 million. So we're told that in the question. So just tidy up these. So we're told the parent is worth 1.8 million, and we're told the NCI, if you go back to the question, is measured at their share of the fair value of net assets. Well, the fair value of net assets acquired was 1.740 million. Therefore, the NCI's share will be 1740 times 0.2. So that's important that you understand where that's coming from. So you measure the NCI at its share. Therefore, the total of both together is 2.148, 2.14 million. The fair value of net assets at acquisition is made up of ordinary share capital, share premium, reval reserve, and retained earnings. So we're given all of them in the question at the date of acquisition. So it's 400,000, 200,000, 100, and 1040. And you'll note the good student will figure out actually these two have moved since acquisition. So ordinary share capital and share premium have stayed the same, but since the 1st of April, which was the date of acquisition, to the 31st December, they have moved. And that will be important for subsequent workings. So always keep an eye on that as you go through. So adding that up, the total, I'll add it here. The total fair value of net assets acquired was 1.74 million, and taking the total cost and value minus the net assets gives me goodwill, in this case, of 408,000. And how do we split that between parent and subsidiary, or parent and NCI should I say? Well, the parent gets 80% and the NCI gets 20%. So if we do that same calculation, the cost minus the fair value of net assets acquired is 408, and you'll see here actually the NCI has no value. So it has no goodwill, and that's why it's called the partial method. If you're measuring the NCI at its share of the fair value of net assets, it will never have goodwill attached. So in this case, you know you're correct, and the goodwill figure to be put in working one will be 408,000. So you start off with how much you're going to either value it at or how much you spent on your share, and compare that to what the actual fair value net assets you got. So for our working one, which is also the answer to part B, the goodwill working for 6 marks, is 408. So there will be no element here of goodwill already, so I just slot in at the very finish 408,000 for goodwill. So now that we've goodwill complete, the 2 or 3 other big workings we have is non-controlling interest, group retained earnings, and if you ever see revaluation reserve in the accounts or in the question, there typically may be a bigger working there as well. So always put a star beside that if you ever see it. There typically is going to be a working involved for reval reserve. So what I typically do is keep them as bigger workings, and we'll do them as we go along. But if you're going to do any of these workings, you're better to do the smaller adjustments first, because sometimes they may impact, particularly on the NCI and group retained earnings. So coming down to the smaller adjustments, we currently have 2. We have unrealized profit, and again we'll come down here. I'll just copy it down. You have intra-group balances. you have two standard ones. Remember, there's only a couple of specific intergroup adjustments that are examinable, so make sure you go back and look at the CAP2 financial reporting assessment. It tells you what is examinable at the interim assessment. The unrealized profit figure here, if we try and calculate it, will be whatever's left on hand, 240,000 of inventory, times 40%, so 240,000, so I'm just rounding to thousands, times 0.4. So 96,000 euro, again I'm rounding the zeros, is the unrealized profit at the end of the year. So just double check whether it says margin or markup. The calculation involved is slightly different. In this case, it is 96,000 unrealized profit, and it's in the parent's accounts, because parent is selling to sub. So that is important because that will dictate where you're making your adjustments. So what the adjustments will be here will be to debit the retained earnings, i.e. the profit of the parent, which this case is Corona, and you will credit inventory. So 96, 96. Now you don't need to write down the journals here, but sometimes they have been asking journals in relation to consolidation, so it's useful to know the journals nonetheless. We're not worried about a P&L here, we're only worried about the retained earnings account. So how would I put those adjustments in? Well, to credit inventory means to reduce it, so all I literally come up here and I will put a minus 96 to signify that that is reducing my inventories when I add them across. So that's how I reduce my inventories. Now some students put in the minus 96 for the parent in here, but remember we're going to be doing a full working on retained earnings, so I'll typically just put a reminder to myself, NB retained earning calc. So put some reminder yourself that when you're going back to do the final calcs, that has to be accounted for. It doesn't impact the non-controlling interest because the unrealized profit is in the parent's accounts, not the subsidiary. So if the sub was selling to the parent, both the group retained earnings and the NCI would be impacted. But only the parent retained earnings is here, therefore we have no interest of adjusting the non-controlling interest. The second element here is we have an intercompany balance. The parent company has an amount owed from the sub. So again, one is in trade receivables and one is in trade payables. Under IFRS 10, like the unrealized profit, this must be eliminated. So because both of them match, as you're told they match, so there's no goods or cash in transit, you will simply debit trade payables, credit trade receivables to 160, 160. So again, similar to what we did with inventory, this has no impact on group retained earnings, nor does it have an impact on the NCI. So we just go up to trade payables, and we do minus 160, and we go to trade receivables, and we do minus 160. So again, that's how in a columnar method it would be done. It would be different if you're approaching it from a T account approach, but again, there's other screencasts that will look through that approach as well. So we've dealt with our smaller adjustments. There's only two, because everything else is information for other parts of the question. So we now go back and we try and figure out the rest in terms of the bigger workings. As I said, typically you'll have bigger workings for goodwill, non-controlling interest, group retained earnings, and then finally the reval reserve. How you value non-controlling interest, you essentially, your starting point for non-controlling interest will be the value at acquisition. So the value at acquisition here, you valued it at 348. So again, we're using method 1, so it's 20% of the net assets at acquisition. And well, that was the value, remember, at the 1st of April 2015. So I'll change that date. So the 1st of April 2015. But we now want to figure out what is it at the 31st of December 2015. So it's important you understand the basic, well, what moves the non-controlling interest during the period. And the predominant one that we're looking at here is post-acquisition profits for the sub. So what have been the post-acquisition profits? So I'll just move this over one. For the sub for the year, i.e. between the 1st to the 4th and the 31st to the 12th. So you try and figure out how much profit has Down and Med from the date of acquisition to the date of the financial statements. And how you get that just from the statement of financial position is you look at the movement in retained earnings. So remember we highlighted this earlier. When we bought it, retained earnings was 1,040,000. It is now 1.8 million and 40. So 1.84 million, and it was 1.04 million. So the post-acquisition profits, let's bring this over another one just to make sure it lines up, is 1840 minus 1040. So they must have made profits of 800 grand for those 9 months. That's the only way retained earnings could have gone from 1040 up to 1840. And of course you have to remember that the NCI has a particular share of that. Their share in this case is 20%. So 20% of 800 is 160. So that's important there because you had made profits during the year for the subsidiary, but the NCI is only entitled to 20% of those. Now that same logic also applies to revaluation gains. So just take a second and see, can you figure out how much revaluation gains have been made since the acquisition and how much does the NCI get attributed. So hopefully you've seen that the post-acquisition reval gains were €200, or sorry, should I say 100,000 euro. So 200 was what at the end. You started off with 100,000, so there must have been post-acquisition revaluation gains that go to the reval reserve of 100,000, and of course the NCI will get 20% of those as well. So 20,000, 20% times 100,000, and then adding them up gets me to an updated NCI at the 31st to 12th 2015 of 528. And that again answers your part A, show the closing non-controlling interest. So it's important to remember you start off with the value at acquisition, which comes from your goodwill working, and you only add on their share of post-acquisition profits or gains. So that's an important, it's not all of these, so it's not the full 200 or the 1840, you're only adding on the post-acquisition share, because you've already added here the pre-acquisition. So this is what's called pre-acquisition at the date of acquisition, and before, you're only interested in allocating then what has happened subsequently. So working 2 gives us a non-controlling interest, which I neatly put in as a single figure, and the examiner can follow then where it's coming from, 528. So we've done our goodwill, we've done our non-controlling interest. Our next one is group retained earnings. The starting point for group retained earnings is the parent retained earnings, which in this case we can get is 2090. So that's the parent alone. And do we have any adjustments to that? We have one adjustment, unrealized profit of, if you'll see, it's minus 96. So if you come back here, we had one reminder, that is reducing the retained earnings of the parent, which of course knocks onto the group, by 96,000. So we have a minus 96 there. I'll just copy the format over. And similar to the NCI, there will be a post-acquisition, post-ac profits of sub. So these don't change. They still had post-acquisition profits of 800. However, you're going to allocate, I'll just move this down to make it clear. You're going to allocate the parent share is 80%. So you can see you're doing very similar things to the NCI and the parent, but you're splitting between the 20-80 ownership. So in this case, the share of the post-acquisition profits going to the parent, and it's going to show up in group retained earnings, will be 640,000. So that's important there, that of the 800,000 you allocate 160 to the NCI, and you allocate the 640 remaining, which sums to 800, to the group retained earnings. Now there's nothing else in group retained earnings. We do not allocate reval gains to retained earnings, because you allocate that to its own line item, the revaluation reserve. So while the NCI only shows up as one single item, where you combine retained earnings and reval reserve, for the actual group share, that is the parent's share, the 80%, they are split out because you see them on the face of the financial statements. So our group retained earnings here are 2634, and again we'll just cross-reference in working 3, retained earnings, working 3. So you see we don't typically use in the Columnar method, we don't really add these across, we just do a whole working out, 2634. And the final one, if you have it, is the group reval reserve. This is done the exact same approach as here. You start off with your parent's reval reserve, which in this case was 400, and you add on the post-acquisition share from the sub. So you can pause it now and see can you approach that. You start with the parent. There's no specific adjustment to the parent's ones, so we're not told anything else, so we assume that's okay. But you add on then what is the post-acquisition share of the parent for the sub's post-acquisition reval gains. So what gains did the sub make between the 1st of April and the 31st of December, and what share is the parent entitled to of those gains. So the post-ac reval gains for the sub in this case are 100, because again we've calculated up here. We give 20% to the NCI and we're giving the parent 80%. So very similar type approach. You're just splitting up the post-acquisition profits and gains 80-20. So in this case it'll be 100 times 80%, which is 80. So overall then the updated group retained earnings, I should say group reval reserve, working 4, is 480,000. So again, we'll just slot that in, working 4. Some students like to add them across and put an adjustment here, so a minus figure. I prefer to just start with a working from scratch and slot it in, 480. So they're typically the big workings that you will have. And once you have all those done, and when you go through the smaller adjustments you slot in as you go along, you have the majority of the question complete. What you now need to do is finish off the rest of the question, and that merely means adding across each of the line items to ensure you come up with the group figure. Now some of the things you'll need to watch out for, and we'll show you here, we may have done these at the start or you can do them at the finish. But there's a couple of key things you need to watch out for when you're adding across. So for the group, it will be 2500 and 1400 for group PPE, which gets me to 3.9 million. Now the investment in Brigbar we have already used as part of our goodwill calculation. So some students will have put that minus figure in at the start, or you can put it in now. But you have to remember that you will never have the investment in the sub shown in the group financial statements because that's already in the goodwill working. So adding them up, we have non-current assets of 4.308 million. We add across our inventories, which has one adjustment. So parent plus sub plus the unrealized profit gets me to 1.204 million. Same with trade receivables, you add the parent plus the sub and we remove the intercompany balances of 160,000. And finally then you add the cash for both of them with no adjustment, getting me to current assets of 3.294 and total assets overall, which is non-current and current, to be 7602. So once you've structured your approach and keep it very neat, finishing off the question can be very straightforward. So just remember there are a couple of small adjustments to remind you can either do them as you do the goodwill working or leave them in the end. Another such adjustment is to strip out ordinary share capital and any share premium of the subsidiary. Because remember these 400 and 200 are already being used in the goodwill calculation. So if you want to do them at the start, by all means, strip out the investment and the pre-acquisition share capital and share premium. Meaning then we only have left the share capital of the parent and any share premium of the parent. Note we didn't need to do it for here because we did our own separate working in that regard. So we've already automatically done that in working 3 and working 4. We have removed any reference to pre-acquisition. So remember the two figures here, these are what's known as pre-acquisition reval reserve and pre-acquisition retained earnings. But we haven't included them in our calculations down here in working 3, working 4. So some students like to work here and then take off pre-acquisition here and other subsequent adjustments. That is fine as well. Just whatever method you're comfortable with, stick with that approach. Non-controlling interest we've completed as well in a separate working, so we've no worries. And the final one then, well, we'll just do total equity here first. Tot them up, giving me total equity of 5842. And finally then to round it off, we have 1200 plus the sub minus the intergroup balance gets me 1760, and hopefully our total equity plus liabilities will come to 7602. So you can see here it's not the worst approach of a question, but you need to have some structure on how you go about it. The typical first thing is you read the requirements and have a brief look at the information provided and the notes to the question. So we knew straight away up front we had a 20% NCI, we knew there was unrealized profit, we knew there was intergroup balance, and we knew the NCI was measured at its percentage share of its fair value of net assets. So we knew that before we started. I would then typically set up a columnar structure for your statement of financial position. Leave a page or two for your big workings where the bulk of the marks will be going for. Some of them may be asked for as a separate working where you need to show them. So again, bear that in mind where you present them in your answer booklet. And then finally maybe leave another page for smaller adjustments as you go through the notes to the accounts. So having a structured approach, in this case this screencast looked at the columnar method, is very useful for consolidated questions. They do appear fairly frequently, at least one across three exam sittings every year, and it's important you do put the practice in because they will be on the main exam in the summertime for CAP2 as well. So that was September 16, question 2, focused on consolidated statement of financial position using the columnar method.